In every financial crisis, there's a brief moment when normal rules are no longer fast enough. Markets move in minutes. Fear spreads in hours, and legal processes that were designed for stability suddenly feel dangerously slow. That moment is where emergency powers are born. Not because governments want more control in theory, but because the existing system appears incapable of stopping collapse in real time. The pattern is older than modern finance, but it became especially visible in the 20th century. In 1933, as banks failed across the United States and depositors lined up to withdraw what little cash remained, President Franklin D. Roosevelt declared a national banking holiday. Banks were closed by executive order. Contracts were frozen. Gold convertibility was suspended soon after. These actions would have been unthinkable under normal conditions, yet they were framed as temporary necessities, extraordinary steps justified by extraordinary danger. The language mattered. These were not permanent changes to the financial order. They were emergency measures, taken only to stop panic and restore confidence. The same logic reappeared decades later, even when the mechanisms looked more sophisticated. In August 1971, when the U.S. faced mounting pressure on the dollar and a rapid drain of gold reserves, President Richard Nixon unilaterally closed the gold window. The Bretton Woods system, which had governed global money since World War II, effectively ended over a weekend. Again, the justification was urgency. The system was under attack. Action had to be immediate. And again, the move was presented as temporary, a pause meant to stabilize conditions while a better solution was found. By the time the global financial system entered the 21st century, emergency powers were no longer unusual. They were embedded in the architecture of crisis response. But it was the 2008 financial crisis that transformed them from rare tools into a defining feature of modern finance. In the months leading up to the collapse of Lehman Brothers, most people outside the banking sector had little awareness of how fragile the system had become. Mortgage-backed securities were rated as safe. Major institutions reported strong capital positions. Yet beneath the surface, short-term funding markets were seizing up. Trust between banks was evaporating. When Lehman failed in September 2008, the problem was no longer theoretical. Money market funds broke the buck. Interbank lending froze. Firms that appeared solvent on paper could not access cash to meet daily obligations. At that point, traditional legal and political processes were too slow. Congress could debate, but markets were collapsing hour by hour. Regulators could follow existing rules, but those rules assumed orderly conditions that no longer existed. The response was a rapid expansion of emergency authority, especially by central banks. In the United States, the Federal Reserve invoked Section 133 of the Federal Reserve Act, a rarely used provision that allows lending to non-banks under unusual and exigent circumstances. This clause had existed for decades, largely ignored. In 2008, it became the legal foundation for an entirely new financial reality. The Fed created emergency lending facilities almost overnight: the term auction facility, the primary dealer credit facility, the commercial paper funding facility, and others. These programs extended central bank support far beyond traditional commercial banks, reaching investment banks, money markets, and even corporate borrowers indirectly. The rationale was simple and persuasive. Without immediate liquidity, solvent institutions would fail due to panic, not fundamentals. Failure would cascade. The economy would collapse. Emergency lending was not a bailout, officials argued, but a bridge. Once stability returned, the facilities would be shut down. The system would revert to normal. At the same time, the U.S. Treasury proposed a Troubled Asset Relief Program, or TARP, initially framed as a plan to purchase toxic assets. It quickly evolved into direct capital injections into major banks. The speed was unprecedented. Congress passed a $700 billion authorization under intense pressure, warned that failure to act could trigger another Great Depression. Again, the word temporary was central. These were emergency measures, not a permanent redefinition of the relationship between the state and the financial system. Similar dynamics played out globally. Central banks coordinated interest rate cuts. Dollar swap lines were opened between the Federal Reserve and foreign central banks to relieve dollar shortages abroad. These swap lines, too, were justified as short-term crisis tools necessary to prevent the global financial system from fracturing along national lines. What made these actions politically acceptable was not just fear, but framing. Emergency powers were portrayed as technical, neutral, and reversible. They were not ideological choices, but operational necessities. Officials emphasized that markets would return to self-regulation once confidence was restored. Extraordinary interventions would be unwound. Balance sheets would shrink. Rules would return to their pre-crisis state. For most of the public, the crisis ended quietly. Banks reopened. ATMs worked. The feared collapse of everyday life did not happen. From that perspective, emergency measures appeared successful. The system survived. And once survival was secured, attention moved on. This is the crucial psychological shift. When emergency powers work, they erase the counterfactual. No one can see the collapse that might have happened. What remains visible is stability, and stability breeds acceptance. If extraordinary tools prevented disaster once, why question them? Why demand their removal, especially when the memory of panic is still fresh? In this early phase, almost no one asks how emergency powers end. There is no urgency to define exit conditions when markets are calm again. Politicians prefer not to reopen debates that could signal fragility. Central banks, having stepped into unfamiliar roles, now carry responsibility for maintaining the stability they helped restore. The cost of acting is visible. The cost of inaction feels abstract. By the end of 2009, the language of emergency was already fading, but the structures it justified were still in place. The facilities might be closed, but the legal authority remained tested and proven. The precedent had been set. It was now known, not just in theory but in practice, that when the system is threatened, normal constraints can be suspended quickly and legally. This is how temporary becomes meaningful in a very specific way. Temporary does not mean short-lived. It means conditional. The powers last as long as the threat can plausibly be said to exist. And in a financial system built on leverage, confidence, and interconnected risk, the threat never fully disappears. Once the immediate panic of a financial crisis subsides, there's an assumption that the system will naturally drift back to its previous state. Emergency powers, by definition, are supposed to expire. Markets calm down, special facilities close, and the extraordinary becomes unnecessary again. In theory, this is how temporary authority works. In practice, financial systems do not reset. They adapt around whatever kept them alive. The first reason emergency measures quietly persist is structural. Financial systems are path-dependent. Once institutions reorganize themselves around new tools, new guarantees, and new expectations, removing those supports does not return the system to its earlier form. It exposes a different, often more fragile reality. After 2008, banks, funds, and governments adjusted their behavior based on the knowledge that central banks had both the legal authority and the operational capacity to intervene on a massive scale. That knowledge could not be unlearned. Take the Federal Reserve's emergency lending powers under Section 133. Before 2008, the clause existed mostly as a historical footnote, used sparingly during the Great Depression, and largely dormant for decades. After 2008, it became a proven mechanism. Even when specific facilities were shut down, the legal framework remained intact. In fact, it was refined. The Dodd-Frank Act of 2010 placed new procedural limits on 133 lending, but it did not remove the power. Instead, it formalized it. Emergency authority moved from improvised response to standing capability. This shift from exception to infrastructure is one of the most important but least discussed dynamics in modern finance. Once a tool has been used successfully, institutions plan around its potential reactivation, risk models incorporated implicitly. Policymakers keep it available just in case. What was once extraordinary becomes part of the background architecture of the system. A second mechanism that prevents emergency powers from expiring is administrative inertia. Ending a program requires an explicit decision, and explicit decisions create political risk. If an emergency facility is shut down and a new shock occurs, the officials responsible can be blamed for acting too soon. If the facility remains available but unused, there is little immediate cost. Over time, the bias always favors keeping tools in place rather than dismantling them. This logic explains how many crisis-era measures are not extended in their original form, but instead quietly transformed. Temporary programs are rebranded as standing facilities. Sunset clauses are replaced with review processes. Authorities shift from discretionary language to technical frameworks. The power remains, but its presentation changes. It no longer looks like an emergency response. It looks like routine governance. A clear example of this is the evolution of central bank balance sheets. During the 2008 crisis, large-scale asset purchases were introduced as a temporary measure to restore market functioning. Quantitative easing was framed as an unconventional tool for unconventional times. Once markets stabilized, it was widely assumed that balance sheets would return to pre-crisis levels. That never happened. Assets declined modestly in some periods, but the baseline ratcheted higher after each intervention. By the time the COVID-19 shock hit in 2020, there was no hesitation. The same emergency powers were deployed again, faster and at a larger scale. The Federal Reserve revived and expanded many of the 2008-era facilities within weeks. Corporate bond markets were explicitly backstopped. Even exchange-traded funds were included. None of this required new legal innovation. The framework already existed. What had once been controversial was now operationally normal. Internationally, the story is similar. Dollar swap lines between the Federal Reserve and foreign central banks were initially framed as crisis-specific tools to address acute dollar shortages. After 2008, these swap lines did not disappear. They were converted into a semi-permanent global network. Some lines became standing arrangements, available at any time. Others could be activated quickly with minimal coordination. In effect, a global lender of last resort system emerged without a formal treaty or democratic mandate. This permanence is not the result of a secret decision to hold on to power. It emerges from fear and responsibility. Policymakers who lived through a crisis internalize its costs. They remember how close the system came to collapse. From their perspective, removing emergency tools feels reckless. The absence of crisis is interpreted not as proof that the tools are no longer needed, but as evidence that they are working. There's also a subtle legal dynamic at play. Emergency powers are often easier to create than to repeal. They are justified under broad mandates and vague language designed to allow flexibility under stress. Reversing them requires narrow, precise legislation, which demands political consensus. In polarized environments, that consensus rarely exists. As a result, authority accumulates through crisis, but dissolves only slowly, if at all. Over time, the justification for these powers shifts. Initially, they are defended as necessary to stop collapse. Later, they are defended as necessary to preserve stability. Stability becomes a new emergency. Volatility itself is treated as a threat requiring intervention. This redefinition allows extraordinary measures to persist without ever being formally extended. Perhaps the most important reason emergency powers do not expire is psychological. Once markets know that a backstop exists, they behave differently. Prices reflect not just fundamentals, but anticipated intervention. Liquidity providers take more risk. Governments borrow more confidently. If the backstop were removed, the adjustment would be painful and immediate. That pain would be blamed on whoever removed the support, not on the years of dependency that preceded it. In this way, emergency powers create their own justification. The longer they remain in place, the more disruptive their removal becomes. What began as a response to crisis evolves into a condition of normal operation. There is no clear moment when normal returns, because normal has been redefined around the presence of extraordinary authority. By the time observers realize that a temporary measure has no clear endpoint, the question is no longer when it should expire, but whether it can be removed at all without triggering the very crisis it was designed to prevent. As emergency powers settle into permanence, their most profound effects are no longer visible in press releases or legal texts. They appear in behavior. Markets change how they price risk. Institutions change how they plan for failure. Governments change how they borrow. Over time, a new equilibrium emerges, one that depends not on the absence of intervention, but on the expectation of it. In theory, financial markets are supposed to discipline excess. If risk increases, borrowing becomes more expensive. If leverage grows too high, lenders pull back. Losses force correction. Emergency powers weaken that feedback loop. When participants believe that extreme outcomes will be contained by authorities, the distribution of possible futures narrows. The system becomes less tolerant of pain and more reliant on protection. This dynamic is often summarized by the phrase the central bank put, most commonly the Fed put. The idea is not that policymakers promise to support asset prices, but that markets behave as if such a promise exists. When conditions deteriorate sharply, intervention is expected. When volatility spikes, liquidity will appear. This belief is not abstract. It is grounded in experience. After 2008, after 2020, and after multiple smaller episodes in between, markets learned that systemic stress triggers support. The consequence is a subtle but persistent distortion of risk pricing. Assets that would once have demanded a higher risk premium now trade at valuations that assume rapid stabilization. Credit spreads compress faster. Equity drawdowns recover more quickly. Losses feel temporary. This does not eliminate risk, but it shifts it. Risk moves from visible price volatility to hidden balance sheet fragility and long-term dependency. For financial institutions, this environment reshapes incentives. Large banks and funds do not consciously plan for bailouts in a crude sense. Instead, they structure themselves within a system where tail risks are shared. Liquidity risk, in particular, is no longer managed solely through private buffers. It is partially outsourced to the central bank. Emergency lending facilities, standing repo operations, and swap lines form an implicit safety net that allows institutions to operate with tighter margins of error. This safety net is uneven. Smaller actors without direct access to central bank support face harsher discipline. Large, systemically important institutions benefit most from emergency frameworks because their failure carries broader consequences. Over time, this reinforces concentration. Scale becomes a form of insurance. Size is not just efficient, it is protective. The effects extend beyond finance into public policy. Governments, observing the stabilizing role of central banks, adjust their own behavior. Deficits become easier to finance when markets believe that disorderly outcomes will be contained. Rising debt levels do not trigger immediate crises because the institutional backstop dampens panic. This does not mean fiscal limits disappear, but they become less visible, less binding in the short term. At the same time, the distributional consequences become harder to ignore. Emergency interventions tend to operate through financial markets. They support asset prices, credit availability, and liquidity conditions. Wages, by contrast, adjust slowly. The result is a widening gap between those whose wealth is tied to financial assets and those whose income depends primarily on labor. This outcome is not usually an explicit goal of policy, but it is a consistent byproduct of market-based stabilization. Legal and democratic accountability also shift in this new normal. Emergency powers often sit at the intersection of technical authority and political impact. Central banks are insulated from direct electoral pressure by design, which allows them to act quickly. But as their actions shape distributional outcomes and long-term economic structure, the line between technical management and political decision-making blurs. Parliaments and Congresses retain formal authority, but in practice, they react rather than lead. During crises, decisions are made first, justified later. Emergency facilities are announced over weekends, implemented by regulatory interpretation, and only subsequently reviewed. Once markets adjust to these actions, reversing them becomes politically costly. Oversight occurs after the fact, when the range of possible outcomes has already narrowed. This creates a form of democratic asymmetry. Powers expand rapidly under pressure, but contract slowly, if at all, during calm periods. Each crisis adds layers of precedent. Each intervention becomes evidence that similar action will be taken again. Over time, the system operates under a set of assumptions that were never directly debated or approved by the public, but are nonetheless binding. Perhaps the most important transformation is cultural. Market participants, policymakers, and even the public begin to internalize the idea that severe financial instability is unacceptable, not merely painful, but illegitimate. Volatility is no longer a natural feature of capitalism. It is treated as a policy failure. This mindset shifts expectations. The goal is not resilience through adaptation, but stability through control. The paradox is that this approach can make the system more fragile in the long run. When small shocks are consistently absorbed by intervention, larger imbalances can accumulate. Leverage builds quietly. Correlations increase. The system appears calm, even robust, until it is not. At that point, the required intervention is larger than before, reinforcing the cycle. By the time this new normal is fully established, few people remember what a financial system without permanent emergency powers looked like. Younger market participants have never experienced one. For them, central bank backstops are not exceptional. They are simply part of how the world works. The idea that markets could be left to fully clear on their own feels theoretical, even dangerous. This is a lasting legacy of emergency authority. It does not announce itself as a revolution. It embeds itself through repeated use, shaping expectations until alternatives seem unrealistic. No vote is taken. No formal declaration is made. Yet the system that emerges operates on assumptions that would have been controversial, even unthinkable, before crisis made them feel necessary. By the time emergency powers become part of everyday financial reality, the question of whether they should end is no longer asked in practical terms. Instead, the system revolves around a quieter, more difficult question. What would happen if they did? The absence of a clear answer is the strongest reason these powers never truly expire. At a structural level, modern finance has no natural stopping point for emergency authority. Financial crises do not end with treaties or formal declarations. There is no equivalent of a peace agreement that signals a return to normal conditions. Risk evolves continuously, leverage rebuilds gradually, and confidence shifts invisibly. Because the threat is never fully gone, emergency justification can always be extended. The language changes, but the logic remains intact. This is why financial emergencies resemble permanent states of exception. In wartime, governments suspend normal rules with the understanding that hostilities will eventually cease. In finance, instability is not an external enemy. It is generated by the system itself. That makes the emergency self-renewing. Each intervention reduces immediate pain, but increases future dependence. Each cycle leaves behind new infrastructure, new precedents, and new expectations. There is also a deeper asymmetry between action and reversal. Deploying emergency powers is decisive and visible. Withdrawing them is gradual, uncertain, and politically dangerous. If intervention prevents collapse, it is praised or quietly accepted. If withdrawal triggers turmoil, it is blamed. This imbalance ensures that policymakers face constant pressure to act, and almost no pressure to fully step back. Over time, emergency authority becomes a form of insurance that no one wants to cancel. Markets price its existence. Governments plan around it. Institutions depend on it. Removing it would force a sudden repricing of risk across the entire system. Asset values would adjust. Borrowing costs would rise. Failures that have been deferred would surface. Even if such an adjustment is economically healthy in theory, it is politically intolerable in practice. Importantly, this persistence does not require bad faith. Policymakers do not need to seek power for power's sake. Most are acting under a narrow mandate, prevent systemic collapse. Within that mandate, keeping emergency tools available is the rational choice. The costs of overuse are diffuse and long-term. The costs of underuse are immediate and catastrophic. Faced with that trade-off, caution always leans toward intervention. As a result, emergency powers evolved into a baseline condition. They are no longer justified by reference to a specific crisis, but by the need to maintain confidence itself. Stability becomes both the goal and the justification. Any threat to it, real or perceived, can be framed as grounds for extraordinary action. The emergency never ends because the definition of emergency expands. This creates a quiet reordering of responsibility. Risk is no longer borne primarily by those who take it. It is absorbed at the margins by institutions with the authority to create liquidity and rewrite constraints. Losses still occur, but the most extreme outcomes are softened or delayed. The system functions, but it does so on borrowed time and borrowed credibility. The paradox is that the success of emergency powers is what ensures their permanence. Each time they prevent collapse, they validate themselves. Each time they are used, they make future use more likely. The system becomes increasingly difficult to imagine without them. Alternatives feel abstract, dangerous, or naive. There is no clear villain in this process, and no single decision that can be reversed to undo it. Emergency authority accumulates through repetition, not declaration. It persists because dismantling it would require accepting instability, at least temporarily. Modern political systems are not designed to tolerate that kind of uncertainty. In the end, emergency powers do not survive because they were meant to last forever. They survive because the world they operate in never returns to a state where they seem unnecessary. What was once described as temporary becomes indistinguishable from normal. And when a temporary measure defines normality for long enough, it stops being questioned at all. If an emergency has no end date and no clear threshold for resolution, then it is no longer an exception. It is a condition. And conditions, unlike emergencies, are not designed to expire.